Hey guys, you're going to have to forgive me for this video. We're going to be talking about contra accounts and adjusting accounts, and I have to make a confession. Adjusting accounts and contra accounts, they're two topics in accounting that I get, but it's very difficult for me to explain in the way that I've been explaining everything else. So, kind of being all silly about cash, it's ready money, and trying to make everything just seem natural. But with contra accounts and adjusting accounts, I just feel myself going into professional mode. It's not one of those things that I can just explain very easily, and that's a weakness on my part. I have to do more to understand it. They're one of those accounts I actually need to really think about when I see them. If I see an example, I actually need to think about it. So if we were in class and we had a written exam, I could most likely work my way through contra and adjusting accounts. Well, I'm pretty confident I can. But if I had to go up in front of class to explain them, I sort of have I haven't gotten that flexible with them. I can tell you what they are, absolutely. So contra accounts, out of all the accounts that we've been talking about, contra accounts actually they're subtracted from other accounts. Okay, so an example would be depreciation expense. So you know that our assets are worth less at this point. Well, not worthless, but they are worth less. And you obviously you'd be debiting expense because we're increasing our depreciation expense, and we'd be crediting our asset. We're losing some of our stuff. Again, we think of everything in the monetary value. So we're losing some of the cash is peeling away from that long-term asset that we have, that one of our property, plant, equipment, so things like that. That's really what a contra account is. It takes away from another account. But for me to go maybe that's a good enough, but it's not. I can't make any excuses or give myself any shortcuts. What I do want to recommend is that you can look around for other videos that explain in detail how to actually make journal entries for contra accounts. You already understand how to make entries into T accounts and trial balances. You know that already. But different contra accounts, I believe that you need a bit more explanation. What I've just said, in my opinion, doesn't suffice. I don't think you have a natural, fluid understanding of contra accounts just from what I've just said. But they are just accounts that take away from other accounts. Okay, so allowances, we haven't really gone over allowances, but accounts receivable, for example. If people promise to pay us $100,000, but we know really that some people are not going to be able to pay us the money, and we make an allowance that, let's say, out of the $100,000, $5,000 we're not going to be able to collect. That's something that would take away from our accounts receivable. Okay, and you just have to understand how to make journal entries for them. Now, adjusting accounts, on the other hand, I'm more comfortable explaining, but again, my conscience doesn't sit well with me with what I'm going to tell you. Okay, so contra accounts and adjusting accounts, I'm giving you overviews of what they are, but I would like you to do your own investigation. I beg you, I invite you to do your own investigation. I actually wasn't going to make this video, but it felt weird cutting a corner and at least not giving you a chance to understand that there is something that we haven't gone over. There's probably some aspects of accounting that we haven't gone over in general. Hopefully I'm able to catch them and catch up, be able to make videos about them. But for right now, I'm going over the things that I believe will give you a strong, confident, fundamental understanding of, the bedrock of business, which is accounting. Okay, so adjusting accounts. Really, what you could think of adjusting accounts as are they're adjusting entries, and they affect the balance sheet and the income statement. Okay, they're always going to. That's one characteristic of adjusting accounts. All right, so they bring assets or liabilities into proper amount, and I'm going to try and explain this visually. So they're bringing assets or liabilities into proper balance. All right, and what does this mean? So we've gone over unearned revenue, and the example we used was that we were coming out with a very cool phone that was going to beat the iPhone, and everyone wants it, so they give us money ahead of time. So what happens is that people send us all that money, and it's unearned revenue, and it's a liability. We know this already. There are no excuses. We already know that this is a liability. But what happens when we actually start delivering the phones? What happens is that we have to adjust, and these are just the adjusting entries. Okay, so the unearned revenue would turn into regular revenue. So at the beginning, like there'd be a transaction, especially if you're just looking, if you're in accounting and you're looking through the notes of a business owner, or any of the places of the ways you get the information about the business, any of the documents that you have available, and you see a transaction, delivered phones that were already pre-bought by customers. So we would know we've earned the money, and see, it goes from balance sheet to income statement, and that's the key about these adjusting entries. All right, so we go from unearned revenue, we turn into revenue because we finally delivered the good. So we go from balance sheet to income statement. So that's a key about adjusting entries. And if you think about it, knowing, because you at this point know how to make journal entries, what's going on here? All right, think for a second. Unearned revenue, that's a liability, right? So we're debiting liability at this point because we have less of them now. We've delivered the phones. Now that money is ours. We're turning to ours, and we're crediting revenue. You see how it works? That's all an adjusting entry really is. It's bringing our asset or liability into proper balance because something has changed. Goods have been delivered. So let's see how it works in the sense of expense. Again, this would be on the income statement. Okay? Maybe I should have said first our prepaid stuff, our prepaid expense. It could be prepaid anything. So rent is the one we were using, I remember. So I apologize. So prepaid stuff is balance sheet. I wiped the last couple seconds out of your mind. Prepaid stuff is balance sheet, and income statement is expenses. And I said the adjusting entries, you have to remember, they're awesome because they bring things into balance. All right, so this is no longer going to be an asset because we paid for our rent ahead of time, but once the month's over, and that's all we paid for is 1 month. Once the month is over, it's now just an expense because we don't have a claim to that money anymore. We've stayed in our landlord's space for a month. So it's going to hurt our income. Okay? So what's the key that you're noticing about this adjusting entries? I said it already. The goods are being delivered. The services are being delivered. So at one point, this was prepaid and was an asset, and we're like, yeah, okay, I gave you a bunch of money. You haven't really delivered anything yet. I haven't used the space yet. So that's technically still my money. But once we use the space, it's now an expense. Okay? So think about adjusting entries quite simply as balance sheet accounts after delivery of a good or service affecting the income statement. So that's all you have to realize for adjusting entries. So let's actually go back to the prepaid stuff example. What's prepaid stuff? It's an asset, right? So we prepay rent. The month's over now. We prepaid only 1 month's rent. And as soon as the month's over, now it's an expense, income statement. So what's happening? We're crediting. So once this has happened, once we've actually stayed and utilized the service of that space, we credit the asset because everything's over now, and we debit the expense. So one more time, adjusting entries, they bring assets or liabilities into balance, and they affect the balance sheet and the income statement. So when you're looking at certain examples, always think what's actually going on here. That's why the whole time we've been using very simple words. So unearned revenue, we know it's money that we haven't earned yet. So it's a liability. We spoke about this already. Prepaid expenses. Okay, we're being heroes here. People like that. People like to get their money ahead of time. But guess what? They can't get carried away because it's technically still our money. And the adjusted entries make everything make sense because now trade has happened. All right, think of this hour. Think of adjusting entries, making everyone equal, making things what they should be. So when you look at assets and liabilities, if you see prepaid expenses, it's weird. A prepaid expense, it has the word expense in it, but it's an asset, right? So we have to make that normal. So you're going to know that's subject to change because we have to make it make sense. Unearned revenue, it says revenue, but we have to think about a liability. Why? That's really weird. Revenue is supposed to be a good thing, but we're looking at it as a liability. Is a problem there. That's something we're going to have to adjust eventually. So knowing the nature of these things and knowing how to actually write them into our trial balances, you don't have to confuse yourself with contra accounts and adjusting accounts. All you need to know is that, what's the action of actually crediting and debiting? It's still going to follow that same intuitive process that we've been talking about, but you need to understand that those things that look a little bit off on a balance sheet, the things that have revenue in them, but they're liabilities, the things that have expenses in them, but they're assets, prepaid expenses being assets, unearned revenue being liabilities, you're going to have to make that right. That weirdness that you feel when you look at those words, you're going to have to make that right. You're adjusting, and it's going to affect the balance sheet and the income statement. It's always, the adjusted entries are always, once goods are delivered, it's always going to affect the balance sheet somehow. It's going to be either credited or debited, and it's going to affect the income statement. It's going to be credited or debited. Now, contra accounts, on the other hand, they just take away from other accounts. They're just subtracting from other accounts. Again, this is a quick overview of the adjusting entry and the contra accounts. Please do yourself a favor, especially if just do yourself a favor and take a deeper look into things. Take a deeper look into things in general. Always take a deeper look into everything, but especially contra accounts and adjusting entries. I apologize that I could not make this as, whatever my hands are doing right now. I wish I was able to do that with these two things, but I tried my very best. And it's just one of those things where I actually have to be quiet when I think about them. So kudos to those two. They're an interesting part of accounting, but we're almost done with principles of accounting. So yay, we've come pretty far.